Thank you once again. Good day, students. I will be doing this question on chapter 6 of one of the cost and management accounting textbooks. And this textbook is chapter 6, focusing on the manufacturing statement and compiling the income statement. And I've extracted this question from one of the past papers from one of the institutions. And this question is out of 19 marks, where we are focusing on the manufacturing statement and also on the income statement and calculation of the cost per unit. Now, I want to begin by reading what is required, or reading my requirement before I do my analysis. We are required to compile the manufacturing statement, compile the income statement, and if 1,000 products or units were manufactured, then what was the correct product cost per unit, or what was the cost of one unit, or in other words, what is the production cost per unit. So this is what we are required, and we are provided with information where it says that Gupta Limited provides you with the following information for the year that ends 31st of December in the year 2001. We are given inventory, and our inventories, in other words, we have three types of inventory. Inventory of raw material. I want to begin with the raw material. We have inventory of work in process, number 2, and inventory of finished goods. Because we start buying raw material, then we process that raw material into becoming a finished product. So now, hence, I start with inventory of raw material, then I come to the work in process, then after inventory of finished goods. We are given, for all these types of inventory, the opening balance and the closing balance. And I will be using some ledger accounts to explain all this opening and all this closing and how they connect to one another. More especially the work in process, it is very crucial for us to have a deeper understanding of exactly what does the work in process contains, or what does the work in process is all about, where is it coming from. So now I will dwell more on that, and also on the raw material. And below we are given some random items: sales, direct material, telephone being joint cost, water and electricity or water and lights being a joint cost, direct material purchased, this is what was bought during the current accounting period. We have indirect material, we have freight on direct purchases, meaning when we bought this material, which is direct material worth 20,000, there was 2,000 that was incurred in terms of the transportation cost. Then we have freight on sales. Remember, freight on sales, this is the delivery cost that we incur when we sell the product to the customer. So now this freight on sales has nothing to do with the production cost or with the manufacturing cost. Then we have depreciation, which is also a joint cost, and indirect labor, which is just an overhead. Then after, we also have rent, which is a joint cost of 40,000 rands. So now these are the costs that have been given or presented in front of us. There is some additional information that needs to be taken into consideration. 60% of the joint costs are allocated to the manufacturing department, meaning 60% of the rent relates to manufacturing, and 60% of depreciation relates to manufacturing, and 60% of water and electricity relates to manufacturing, and 60% of telephone expense relates to manufacturing cost. So now these costs, they relate to manufacturing or to production. That means 40% of this cost is non-manufacturing, and 40% of this cost is non-manufacturing, and 40% of this cost is also non-manufacturing, because 60% is manufacturing related and 40% is non-manufacturing cost, 40% non-manufacturing cost, and also this one, 40% is non-manufacturing cost. Now, When I say 40% of this cost are non-manufacturing, meaning if they wanted in this additional information, if I may say so, or adjustment, they could have said 40% of the joint cost are allocated to non-manufacturing. They could have given it like that, where they say 40% of the joint cost are allocated to non-manufacturing department. So now the minute it is related to a non-manufacturing department, therefore now 60% relates to a manufacturing department. So I will come back on that when I'm compiling the production statement or the manufacturing statement, and also align that with the calculation of the income statement. Now, as I said that I want to dwell very much on the openings and this closing before I start just copying and pasting this in the manufacturing statement. I want to bring your attention to some of the few ledger accounts that are very crucial with regards to this topic. We know that we start buying material first of all. Before we do production, we normally have to buy direct material and also indirect material. So now that means there is a ledger account that is called direct material or we can call it material control. If we don't want to say direct, we can say material control, so that it is inclusive of all types of materials. We can say material control. So there is a ledger account called material control. And there is another ledger account that is called work in process. And this is from a ledger account perspective. I'm explaining the same thing that I'll be doing in the manufacturing statement. Then after the work in process, we will normally have another ledger account. And this ledger account will be called finished goods. Then this ledger account will be called finished goods. So now these are the three major ledger accounts that I will be focusing on. Then after the finished goods, there is another ledger account called cost of sales. This one I might little touch base on it, or I might not touch base on it. There's one ledger account that I left here in between, which is called manufacturing overheads, but I don't want to do it now at this level. It might not be necessary. Maybe later on when I'm doing the general journal, then I might take this into consideration. And just be mindful that I am using this three ledger account to explain the statement that I will be responding to, meaning I am doing the ledger accounts in order to explain the background of the manufacturing statement before I do the income statement. So I will just be using my own random figures and my own random numbers. So now we know that for us to have material, and we know that first of all, material is an asset. It increases on the debit side and decreases on the credit side. And work in process is also an asset, increases on the debit side and decreases on the credit side. And finished goods also are an asset. They increase on the debit side and they decrease on the credit side. And cost of sales increase on the debit side and they decrease on the credit side. So have this at the back of your mind. So now for us to have material that is available to be used in the production department, and I want also to highlight that the work in process is the production department. This is production process. This is where we do the production. And also again, I want to bring your attention to material and say this is the storage. This is where we store the material. We buy material and we keep it in the storage. And the storage is called material control, where we keep all the materials that we have. So now all the material that we have will be kept in this material control ledger account. So now this is the material control ledger account where all the material will be kept, which is the storage. Now, I'll just bring one scenario where we buy material. Whenever we buy material, we'll normally buy material either cash or on credit. So now if the material is bought, it's either it will be cash or on credit. And this is just my own random figure indicating that this is a purchase of material. So now we buy material And after we buy material, therefore now we can use that material in the production department to produce the product that we bought the material to be produced for. So now we bought material and the value of this material is 1,000 rand. Then now we have to take this material and we use it in the production department because it was bought in order for it to be processed to become a finished product. So now meaning we need to issue material from the storage into the production department, and the production department is the work in process. So now if we issue that material, remember it will be reducing our material ledger account on the credit side. So now if we issue that material, therefore now this will be decreasing material. Why are we decreasing material? Because some of the material is going into the work in process ledger account. So now material ledger account will decrease. Let me say we issue material that is worth 800. So now meaning the work in process will increase by the value of the material that was received. So now meaning here we'll have to record direct material because the work in process department or the production department is increasing by the value of the material that was received from the storage department or from the material control account from an accounting perspective. Now we have these two contra entries, and also if we want we can do this in a general perspective, meaning whenever we buy material will be debited. If material was bought for cash, bank will be credited, and if material was bought on credit, creditors or trade payables will be credited. So now I'm at the same time doing the general entries while I'm doing the ledger accounts and also giving you the overview of the background of the manufacturing statement. Then now we know that in order for us to produce a product, or in order for us to convert this material, remember this is material, so now this material must be converted into becoming a finished product. And for us to convert this material, we need conversion cost. And conversion cost is made of direct labor and manufacturing overheads. And those are called conversion cost because they are costs that are used to convert material into becoming a product. So now meaning we need to know how much is our direct labor. So now we need to account for direct labor and randomly assume that the amount of direct labor is 300 rands. Then after now we also need to take into account the manufacturing overheads. When it comes to manufacturing overheads, you'll normally be given a list of the manufacturing overheads, and you need to take all the total of the manufacturing overheads and you write that one amount here as just a random amount as 100 rand. So now this will be how normally will be your process of receiving material from the material control into the production department. And before we can produce or process this material, we need to have labor, we need to have our manufacturing overheads. So now meaning our product, when it has these three components, then it will become a finished product. Now let me go back again to my material control. Remember we had material that was worth 1,000 rand and we issued material worth 800, meaning now there must be a closing balance. So let us check now how much will be the closing balance of the raw material control. Therefore now we have the raw material total. Then we need to know how much the balance of the material that was left at the end of the year. The balance of the material will be 200, and this will become an opening balance in the beginning of the next accounting period. So now our closing balance, which becomes an opening balance, the balance brought down, will be 200 rands. So now there we do have our closing balance from the ledger account called material. Then now we have the total of material, total of labor and manufacturing overheads. And this is the total that we have. And we know that it is not all the times that what was in process will be all you converted into becoming a finished product. So now we can have a random assumption that some inventory out of what was available was finished. Remember we had 800 plus 200, which is 1.1, plus 100 rand. Therefore now, meaning the total of the work in process must have been 1,200 rands. So now this is our 1,200 rands, and we assume that an inventory that was in process, meaning part of what was in process during the current year. Remember, this is work in process. Part of what was in process was all completed. So now let us just assume that part of this work in process, which was worth 1.2, part of it or half of it was finished. So now meaning this will go straight to the finished goods account. So now I am randomly choosing an amount of 600 just out of my own mind. But you'll see why am I using these figures and where am I leading you to immediately when I'm done with these ledger accounts. So now, if this is the total of the inventory, or if this was the value of the work in process, and only 600 of the work in process was finished, therefore now the remainder, meaning it became an opening balance. So now therefore now we end up with the balance of the work in process, and this becomes balance carried down, and the balance carried down will be 600, and the balance carried down becomes balance brought down of 600. Then we bring this balance here, balance brought down of 600. So now we have the total of the work in process, or the value of the work in process during the period, which was 1.2, and only 600 was finished. Therefore now 600 became work in process. And the minute this is finished, if you can see that the contra entry is finished goods, here the contra entry, it is finished goods, meaning our finished goods, they increased by the value of the goods of 600 that were finished. Therefore now our finished goods ledger account must increase by an amount of 600 rands. So now this means, why is our inventory increasing? Because part of what was in process is no longer in process. Therefore, the contra entry will be work in process. Remember, for every credit entry, there should be a debit entry. So now we are increasing inventory that was finished. Therefore, now in other words, we are reducing what was in process, because whenever inventory is finished, therefore now it is no longer in process. So now these are the goods that we have available in our disposal. Now, I just want again to bring your attention to the fact that some of this inventory that was finished might be sold. So now meaning, out of the inventory that was worth 600, part of it can be sold. So now let us just randomly assume that maybe half of it was sold. So now the minute half of this is sold, meaning the remainder becomes a closing balance. Now we say this is inventory that was available for sales, which is 600. Assume that 300 was sold. Therefore now this will bring us into what we call cost of sales. Remember, the minute we sell inventory, our inventory must decrease on the credit side. And once again, the minute inventory is no longer in process, it must decrease. The minute it is finished, it must reduce the work in process, because it is no longer in process. Therefore now it reduces the work in process whenever work in process is finished. Then that will end up now increasing our finished goods. And the minute finished goods are sold, therefore now meaning inventory that is available for sales will decrease, because part of it was sold. So now I just said that the amount of the inventory that was sold is worth 300 rands, meaning out of the inventory that was available for sales, we sold inventory that was 50%, meaning only 300 rands of the inventory was sold. So now if that is the case, it means this will again leave us with the inventory balance carry down of 300, and this is inventory of finished goods. Therefore now our inventory becomes 300, and this will be a balance brought down. Now remember, for every credit entry there should be a debit entry. If inventory is decreasing because of cost of sales, or because if it was sold, meaning our cost of sales must increase by the amount of 300, and the contra entry will be inventory. So now these are the basic ledger account that you need to master with regard to the manufacturing cost. Now these are the opening balance and the closing balance that I dealt with so far. Now again, bringing your attention to something that is very crucial. I said there are three types of inventory. we have inventory of raw material, we have inventory of work in process, and we have inventory of finished goods. And you can see that all these three inventories are here. Now, I want to then now go into the beginning of the next year. Remember, whatever was the closing balance became an opening balance, meaning now our opening balance of raw material is 200. So now I'm starting the new accounting period, and I'm starting with the opening balance of 200 rands. I'm starting the new accounting period now with the opening raw material of 200 rands. So now here is my balance, and we also, where is this balance coming from? The balance of raw material is 200 rands, and this is the balance at the beginning, balance on the 1st of January. It could be any year, 000, year 2000. So here is the balance of inventory being 200. And at the same time, we know that opening balance of work in process is 600. Now, when we start in the new year, we start with the opening balance. So now let me again start with the opening balance of the work in process being an amount of 600 in terms of rands. Then I start my opening balance in terms of work in process, and this begins with the balance of 600 rands in terms of value. So now this is what is my opening balance. Then I go to my inventory and I say, what is my opening balance of the finished goods? Opening balance of the finished goods is 300. Then I do the same thing with regards to finished goods, and I have my opening balance of the finished goods, and this opening balance will be an amount of 300. Therefore now I begin with my balance of 300 rand starting the new accounting period. Now this is the beginning of the year. Cost of sales will not have any opening balance because this will be closed off at the end of the year to gross profit. Then the closing part, that is from a financial accounting perspective. I'm not going to explain the closing off of the cost of sales. I'll just leave it like that because it's just another concept of closing cost of sales. Now, this is the beginning of the new accounting period now, where we are starting. And now we have inventory that is worth 200 opening in terms of raw material. We have inventory that is worth 600 opening in terms of work in process, and we have inventory that is worth 300 opening inventory in terms of the finished goods. As I said to you that we have three types of inventory with regards to manufacturing company: inventory of raw material, inventory of work in process, and inventory of finished goods. Now normally when it comes to the manufacturing process, they will normally tell you how much material was purchased. Therefore now, meaning in the current year, they will tell you that material that was worth so and so was bought. And if it was bought for cash, you write bank. If it was bought on credit, you write creditors. Therefore now they will say, okay, you bought material that was worth 3,000. This is just another thumbsuck amount. Therefore now, if this is 200 opening, and we had 3,000 that was there in the beginning of the year, meaning our material that is available for use will be an amount of 3,200 rands. This will be material that is available in terms of the usage. This is material available to be used. So now you will normally be given a closing balance, and I want to use this bit brighter color. Now you will normally be given a closing balance, a balance carried down, balance at the end of the year. Now we say the balance at the end of the year is an amount of 300 worth of inventory of raw material. Now the question is, remember we had opening, we had what was bought during the year, maybe plus transportation or import duties. And this is material that was available to be used in the production department. But at the end of the year, we are given closing balance of material, and the closing balance is only 300. And to say what was available was 3,200, but what is left is 200. What happened to the rest? Obviously, the rest is material used. So now, in other words, we want to know how much material was used. meaning how much material was issued into the production department, because what was available to be used was 3.2, but what is left at the end of the year is 300, meaning the rest of the material that is worth 2,900 was issued to the work in process. Therefore, now this is what we call material used. But here we don't write material used, because we know that in the ledger account, the contra entry will be work in process, because this material is issued into the production department. So now meaning material that was worth 2,900 must have been issued into the production department. And I just want to use a different in color here, meaning material that was worth 2,900 must have been used. And if you look in my scenario, I did not tell you how much was issued into the working process, but I gave you the opening balance, and I told you the closing balance, and I have given you what was purchased. So now you had to calculate or determine how much material was issued or how much material was used or was sent into the working process or the production department. And now this is normally how your assessment normally look like when it comes to this type of question. You'll normally be given the opening, you'll normally be given what was purchased, you'll normally be given closing, and you must calculate how much material was issued into the work in process department during the current accounting period. Now, we have calculated that the material that was issued into the production department, as I have shown you, is worth 2,900. And I know that material worth 2.9, it has to go to the debit side of the work in process. This is 2,900. And the contra entry will be material control. Contra entry will be material control, or even if you say direct material, contra entry will be material control or direct material. So now this is the material that was issued into the production department. Remember, this material needs to be processed, and for it to be processed, it needs to be converted into becoming a finished product. And for it to be converted, it needs conversion cost. And conversion cost is direct labor and overheads, meaning we need some employees to process this material. Therefore, now we need direct labor once again. We need direct labor. Remember, there was opening balance of 600 that I'm not ignorant of. And our direct labor can be any random amount, just 1,000 rand is my own figure. Therefore, now what else do we need? We need manufacturing overheads. And our manufacturing overheads, let me just put an amount of 100 rand so that my figures are just simple in terms of calculations. So now we can see that the total of the two is the production cost during the current year. This is the production cost or manufacturing cost. I normally use the word production cost. This is the production cost during the year. During the year. Or manufacturing cost during the year. So now this is what we have as manufacturing cost during the year. So now, meaning what was introduced into the working process during the current year, excluding the opening balance. Then I'll also partly explain that as I proceed further. Now this is what we have now in the table. Then we say, okay, if this is what we have in terms of the working process, therefore now we need to know and say 2.1 plus this will be 3,000, 4,000 plus 6 it will be 4,600. So now it means the value of the work that is in process during the current period, including the opening balance. The value of the work that is in process during the current period, including the opening balance, it is 4,600 rands. So now this is the value of what is in process. Remember, we have the opening balance. Don't forget that. We have the opening balance. We had production that was introduced in the current period. And that production is made of material, labor, and overheads. And it must always be those three components. Now, I just want to bring your attention to the total of what is the total cost of manufacturing during the current year. So now the value of the work that was in process is 4,600, which is opening plus material used. Remember, material used, this is work in process, and this is material used, material that we use in the current year. So now we say it will be opening plus material used plus labor plus manufacturing overheads. That's what we have now as our production cost during the current year. Then we proceed on that same note, and we say now you are given opening, and normally after you are given opening of work in process they will tell you how much is closing. They will give you balance at the end of the year, balance carry down, and they will say your balance carry down is 600. It could be any other amount. I'm just choosing 600. You can choose any other number, but make sure that at least your figures, they are working together. Now we say there was opening work in process, we introduce some material, we incur some labor cost, we incur some overheads, and those were the three costs incurred during the year. And the value of work that was in process was 4,600. But what is left at the end of the year, the value of work in process is 600. What happened to 4,000? 4,000 must have been finished. So now meaning some of the work that was in process must have been finished. So now meaning the inventory or the work in process that is worth 4,000 must have been finished. So now meaning 4,000 of the work in process was finished. So the 4,000 then goes to finished goods. And don't forget that when it comes to finished goods, that there was already an opening balance. So now we say 4,000 was finished and is from work in process. And opening balance, we don't say work in process because it was already set so in the previous calculation when we did the 300. Therefore now we say, okay, 4,000 was finished and is transferred into the finished goods account. And as I said to you that normally you will not be told how much was finished. Maybe they can tell you for you to determine how much is closing. Then in this case, if we are given what is finished and you just say opening plus production in terms of material, labor and overheads, you get to this amount minus finished goods during the year, then you'll get to the closing work in process. Or sometimes you have to say opening plus material plus labor plus overheads minus closing inventory to determine how much was finished. So now this will be what you will be doing in case you are provided information in that format. So now this is where we are, and we say now when the 4,000 was finished, then we need to transfer this into the finished goods account. For every credit entry, there should be a debit entry. That is the double entry rule from Financial Accounting 1. So now, meaning inventory that was available for sales, inventory that was available for sales will be 4,300. Opening plus what was finished during the year. Therefore, now it will be 4,300. And again, remember we have the opening inventory balance. This is inventory of finished goods. Therefore, now they will normally tell you how much is the closing balance. And they will say your closing balance is, let me just say 500. Closing balance of your inventory is 500. And you ask yourself, okay, if the closing balance is 500 and there was opening balance and there was inventory that was finished during the year and what was available to be sold was 4.3, but what is left at the end of the year is less than what was available, what happened to the rest? Obviously the rest must have been sold. So now the difference will be cost of sales. The difference will be cost of sales. Therefore now our cost of sales will be 4,300 minus 500. Therefore now this will give us an amount of 3,800 rands. Just confirm that 4,300 minus 500 will give us 3,800. So meaning out of the inventory that was available for sales, inventory costing 4,800 was sold. Therefore, what is left at the end of the year becomes the closing balance. Even if they give you what was sold, then you'll be able to calculate the closing balance of the inventory of finished goods. So now on that same note, remember for every debit entry, for every credit entry, there should be a debit entry, meaning our cost of sales will be increased by 3,800, 3,800, not 380, 3,800. So now our cost of sales will be increased on the debit side by the inventory that was sold. So now this will be the basics of your ledger account that you need to make sure that you master them at all times. Now, this is how the information flows. And very important to be mindful of is to first calculate material that was used. That is the beginning point. Remember, I told you that material used is this material. This is the material that was issued. Sometimes they will tell you and say this material was issued. So for you to calculate material that was used, we know that it is an opening balance plus purchases plus freight on purchases minus closing inventory of raw material will give us the material that was used. And that material used goes straight into the work in process. It goes to the work in process and we record it there. Then after we say material alone is not enough, we need some direct labor, we need some overheads. Then after we minus the closing work in process. Then after minusing the closing work in process, we say now remember it will be opening plus material plus labor plus overheads, and that gives us 4.6 minus closing work in process. That gives us the value of the inventory that was finished, which will be reducing our work in process. Remember, work in process is work that is not yet completed, it's still in the process of production. Now with this knowledge and this information, I can now go further and I directly respond to the question that you were required to do. Now this was just an overview of the background of where everything is coming from and how it links with the ledger account. And again, when I'm responding to this question, I will show you exactly how this information links with the ledger account. Now we are required to compile the manufacturing statement and compile the income statement and determine the cost per unit or the cost of producing one unit. Now, what are we given first? We are given opening balances. We are given balance of the direct raw material. We are given opening and closing. We are given balance of the work in process, opening and closing. We are given finished goods, opening and closing. So let us start with what we have. Remember, you are not required to do the ledger account. So now I will just be using my ledger accounts just for simplicity's sake, or also aligning what I was explaining with the scenario of this exercise. If does my explanation align with this question that we have in front of us? Now we go back and we check how much is our opening in terms of raw material. As I said to you that the type of material that is normally the first, the raw material. Direct material opening 65,000, closing 52,000. So now we have opening of material 65,000, closing of raw material 52,000. Remember, ledger accounts are not required for you to do in the exam unless stated otherwise. At first year level, normally you'll not be required to do the ledger accounts. Then now we go and check the other aspect of our production cost. Then now we go to the second inventory that we have, which is the inventory of work in process. As I said to you that the second one will be the inventory of work in process. Then I go to the inventory of work in process and I check what do I have in terms of opening and closing regarding the work in process. And I say my work in process, I have opening balance of work in process 25,000 and 27,000. And I go to record that 25,000 and 27,000. Opening is 25,000. Closing, I have my balance carried down as 27,000. So this is my opening and closing of the work in process. Then I need to know my opening and my closing balance of the finished goods. Then now I go and check my opening and closing balance of finished goods. My opening balance of finished goods, it is 27,000. This is finished goods balance, 27,000 and 25,000. Opening being 27 and closing being 25. So now we have finished goods, which is 27,000 and 25,000. So I write my 27,000 and my closing is 25,000. So these are my inventories. And I know that here there will be a line and we are given just the opening balances. So now we started with that one. We need to determine the material that was used first. We need to know how much is the value of the material used. Opening balance, I copied them and I pasted them. Sales, I don't need them yet. Direct labor, I know that my direct labor goes under manufacturing overheads. And I first need my material before I do my labor. I have my telephone, my water, direct material purchased 20,000, and freight, if you remember, freight on purchases, that is 2,000. So now this is my total of my net material purchases. So my total material purchases during the year will be on the debit side. We bought material, therefore now if material was purchased but we don't know either was it cash or credit, that is something that we are not aware of. They say direct material purchased, cash or credit, we are not aware. But let us record that as it is. So now let us say just bank slash creditors, and this is 20,000 rands. Now we had freight on purchases. Freight on purchases could also be bought on for cash or on credit. Then we have bank or creditors, which is for freight on purchases, and this was 2,000 in terms of rents. Now we have to say how much material was available. How much material was available to be issued into the production department. We need to know that. How much material was available. Material available will be opening plus purchases plus transport cost. It will give us the total material that was available to be used in the production department. Then we have 65,000 plus 22,000, and this gives us 87,000 in terms of rents. So now material that was available for use is 87,000 rands. But why do we only have now 52,000 left at the end of the year? Because this is what was available at the end of the year. Or during the year, available during the year. But at the end of the year, we only have 52,000. Meaning some of the inventory was used. Therefore, now inventory used will be 87,000 minus 52,000. 87,000 minus 52,000. This is 35,000. So now inventory that was issued into the working process is 35,000. And that 35,000 will go to the debit side of the working process and it becomes 35,000 rands. And the contra entry will be direct material. This will be direct material. Now material used is becoming 35,000. Then let us go now to our calculation. We are doing the manufacturing cost or manufacturing statement. Then now in doing the manufacturing statement, we start with the direct material used. We want to know the material that was used. Material used, we know that is opening balance plus purchases, then plus freight on purchases, less closing. Our opening, we know that it is 65,000. Our purchases are 20,000. Our freight on purchases are 2,000. And our closing, it is 52,000 in terms of rents. And if we deduct the closing from all this, this will give us the same 35,000 of the material used, which is the same 35,000. So now from the ledger account, I normally say it is very simple. I prefer that students first have you don't have to use the ledger account with the exam because there will be not enough time, but you just have to, I'm using this for the broader understanding of where everything is coming from. Now that we have calculated the material that was used, work in process, in other words, material used or material issued, if you want to simplify it, material issued. Sometimes you might be told that material issued this amount. The minute they tell you this is what was issued, then you know that what was issued is what was used into the production department. Now that we have calculated a material that was used, therefore now we do have our direct material. Remember, we do have direct material in our working process. What else do we need? We need direct labor. Don't forget. So now we need our direct labor. We don't need material alone. Material alone cannot convert itself. So now our direct labor, we have to look at how much is our direct labor from the provided information. Our direct labor is already given to us as 73,000 rands. So now we just go and we paste our direct labor. And our direct labor is 73,000 rands. What else do we need? We need manufacturing overheads. Now don't forget that direct material plus direct labor are called prime cost. I'll show you that when I'm doing the statement. Direct material plus direct labor are prime cost. So now this is manufacturing overheads. I need to go and check how much are my manufacturing overheads. And now there's quite a long calculation when it comes to these manufacturing overheads because there's quite a lot of them. But I'll just bring one amount here. But when I'm doing the statement, I will show you the detailed calculation. So now, as I said that, we need to say plus direct labor. Then after adding my direct labor, I know that I will come to what I call prime cost. And my direct labor is 73,000 rands. And if I say my direct material issued plus 73,000, it will give me 108,000 rands. 108,000 rands. So now I have issued the material into the working process. This is what went into the working process on the debit side. This is the direct labor that went into the working process on the debit side. What else now do I need? I need to add my manufacturing overheads. Where is that coming from? Remember, I need to have direct material, direct labor, plus manufacturing overheads. Now, not forgetting that there is an opening balance of the working process. When I brought the material, the direct material, and the labor, and the overheads, there was already an opening balance. So now I need not to be ignorant of that opening balance, which was already brought in here. So now I come back again to my manufacturing overheads. I need to calculate all my manufacturing overheads. Which one do I have? Telephone, water plus electricity, indirect material. What else I need? Manufacturing related ones, depreciation, indirect labor. I also have rent being the last one. So let me go with the first one. Telephone. Remember, these are joint costs. We only calculating 60% of them. So I'm looking for 60% of the joint cost. 60% of 5,000 will definitely be 3,000. 5,000 times by 60% will be 3,000. So now this is what I'm looking for. I'm looking for the telephone. And I want to know how much relates to the production or the manufacturing. Times this by 0.6 being 60%. This gives me 3,000 rands as the amount of the telephone that relate to production. Water and electricity will definitely be 6,000 because 60% of that will be water plus light. I think they said water plus light. Water plus light, 10,000 is the full amount, and 60% of this will be 6,000, and I only want to calculate the manufacturing related cost. Direct, this is not, this is indirect 9,800, indirect material. Then I have my indirect material, My indirect material is 9,800. That was all related to production. That was indirect material. Freight on that was accounted for. This has nothing to do with the, also plus that one. Depreciation 19,000. 19,000, 60% of that relate to production. Then I have my depreciation. Out of that 19,000, 60% of the 19,000 relates to production. Then I say 19,000, multiply this by 60%, I get 11,400 rands of the depreciation that relates to production. Then I go to the other manufacturing overhead related cost, which is indirect labor, 15,400. It is not a joint cost. Indirect labor, and my indirect labor, it is just confirm the amount, it is 15,400. It is 15,400. Then after we have rent, which in total it is 40,000 rands. But out of the 40,000, 60% of this relate to manufacturing. Therefore, now 40,000 rands times this by 60%, which is 0.6, it will give me a total of 24,000 rands. 24,000 plus 15,400 plus 11,400 plus 9,800 plus 6,000, not 600, 6,000 plus 3,000 plus 3,000. This gives me a total of 69,600. So now this is the manufacturing cost. You must make sure that you do all these calculations. So now my manufacturing cost is 69,600. Don't forget that from a ledger account perspective, the 69,600 will be here. And now we have all the three elements of the production cost. What are those three elements? It is material, it is labor, it is overheads. But we need not to forget to say plus opening balance of the work in process. So now when we add the opening balance of the work in process, we can draw a line here. When we draw a line, then I will be able to say, okay, 69,600 plus 73,000, which is our direct labor, plus 35,000 of our direct material, plus 25,000 of the opening work in process. This will give me a total of 202,600. This is the value of the work in process, 202,600. This is the value of the work that was in process during the current year, 202,600 rands. And if this is the value of the work that was in process, I need to approve it from my statement. In my statement, don't forget that we will have manufacturing current. I want to say current manufacturing cost, meaning manufacturing cost for the current year only. I'm focusing on the current year. It will be prime cost plus conversion cost. Therefore, now I will just say 108,000 plus 69,600. This gives me an amount of 177,600. This is the cost of production in the current year. Where is this 177 coming from? Because we have never seen it in the ledger account. It is there in the ledger account. If you add these three, which is material that was introduced and labor introduced in the current year and overheads in the working process, you'll get exactly the same amount. Material was 35,000 plus 73,000 plus 69,600. We get the same 177,600. So now the 177,600, it is before the opening balance was added. So the minute we add the opening balance, then it brings us to the value of the work that was in process during the year. So now, meaning the 25,000 is not yet included in this current manufacturing cost, meaning cost of manufacturing that was introduced during the current year, or cost of value of the work in process in simple terms. Let me just use that term, value, current value of the work in process, or value of work in process introduced in current year. Just to simplify for you, this is the value of work in process that was introduced in the current year, CY meaning current year. So that is the value of the work that was in process introduced in the current year. But this line item is not very crucial that you also write it. So now we know that we need to add our opening balance. We need to add our opening balance. This is the opening balance of work in process. If you remember, the 25,000 that need to be added. Which 25,000? The 25,000 opening balance of work in process. Add to that 177,600. That will give us the 202,600 of the value of work in process. So now after we have added that 25,000, it will give us exactly plus 25,000. It will give us 202,500. So now this is work in process available to be finished. In other words, this is the value of the work that was in process, which was a value of work in process during the year. Value of work in process in current year. This is the value of the work that was in process. Now, what else do we need to take into account? Coming to the ledger account again. If this is the value of the work that was in process, why at the end we only have 27,000? If you see that at the end of the year, we only have 25,000. But what was in the work in process in total was 202,600. But what is left in terms of the value of the work that is in process is only 27,000. What happened to the rest? Meaning the rest was finished. So now meaning we will have to say 202,600 minus 27,000. And this becomes finished goods. This is finished goods. So now our finished goods becomes 175,600. So now meaning we need to deduct the closing work in process from the value of the work that was in process during the year. So now same applies here, meaning out of the value that is the value of the work that is in process, we need to say less closing work in process. And we less our closing work in process, and our closing work in process is 27,000 rands. So we deduct our closing work in process of 27,000 rands. Then the minute we do this, we start now getting to the cost of finished goods. Cost of finished goods. So now the cost of finished goods, as you can see that this is finished goods, 175,600. So the cost of the finished goods, it is 175,600 rands. Now the minute the goods are finished, don't forget, the minute they are finished, they are leaving the work in process, meaning they are decreasing the work in process, and they go to finished goods, meaning the finished goods ledger account must increase by the inventory that was finished. Therefore, now 175,600 will be recorded as an increase in the finished goods, and the contra entry will be work in process, because when the inventory is no longer in process, therefore now it reduces the work in process and increasing the inventory of the goods that are finished. And when we bring this 175,600, don't forget there was an opening balance. So now if there was an opening balance, we need to say opening balance of the finished goods plus finished goods in the current year. Therefore now we say plus 27,000 of the opening balance. Then after we have now a total of 202,600. Then now we have 202,600. Therefore now this will be 170. Yeah, the amount is the same. It will be the same amount because we deducted here 27,000 in order to get there, and if we add 27,000, then it will bring us the same amount in terms of numbers, but it's not always the case. That's the coincidence of numbers. So now, meaning the inventory that is available for sales, this is what is available for sales. We can sell all the inventory worth 202,600. Then I will say this is what was available for sales. Then why at the end of the year we only have 25,000? So now it means some of the inventory that was available for sales must have been sold. That is why what is left now is only 25,000 rands worth of inventory of finished goods. So now for us to determine the cost of sales, therefore now meaning another one was sold, therefore contra entry will be cost of sales. Meaning now we just have to say 202,600 minus 25,000. When we minus 25,000, we get 277,600. So if this was finished, if this was sold out of what was finished, therefore now my cost of sales need to increase by inventory. Therefore now I'll have 177,000 some 600 in terms of rents, 177,600. So now meaning my inventory of finished goods will decrease by the inventory that was sold. Then the remainder becomes the closing balance. Now remember, this is inventory available for sales, and inventory available for sales is inventory finished in the current year plus opening inventory. Let us go there on that same note. This is cost of inventory finished, 175,600, and here is 175,600 plus opening finished goods of 27,000. So now meaning out of the cost of goods that were finished during the year, we need to say now that these are finished goods. Take note, finished, I have WN here. These are finished goods. If these are finished goods, then we need to add opening finished goods. Opening goods. Our opening finished inventory, let us check it from the ledger account. Our opening finished inventory, it is 27,000. So now we just come here, we say our opening, it is 27,000. So the minute we add our opening from that 175,600 plus 27,000, it gives us 202,600. 202,600 is inventory available for sales. This is what is available for sales. And if this is what is available for sales, then the question is, why? What is left at the end of the year? What is left at the end of the year is only 25,000, meaning this one must have been sold. Therefore, now let me again start on the new page by saying available for sales. Available for sales. And inventory available for sales is 202,600. Therefore, now we say less closing goods. Closing finished goods. And when I subtract my closing finished goods, which I think is 25,000 rands, yes, closing finished goods being 25,000 rands, deducting from that 202,600, it will give me a total of 177,600 rands. That is what has been sold. So now minus 25,000 rands. Therefore now I will have to say minus 25,000 rands. This gives me a total of 177,600. This is the cost of manufacturing. cost of manufacturing. Cost of manufacturing goods. Cost of goods sold. Cost of goods sold. So now this becomes the cost of the goods that were sold. The cost of the goods that were manufactured was also calculated along the way, the cost of finished goods. Now, now that we have completed this, therefore now we can now do the income statement. We can now do the income statement. Now, doing the income statement, also nothing new. We are now doing the income statement. Our income statement, it is sales minus cost of sales. And cost of sales will be opening plus manufacturing cost or production cost minus closing. Then this will give us the cost of goods that were sold. Then our opening, remember, we are focusing now on the opening inventory of finished goods because we are focusing on the cost of goods that were sold. Opening inventory of finished goods. Opening inventory of finished goods. Opening inventory of finished goods was 27,000 plus cost of goods that were finished during the year minus the closing of 25,000. Let me just come to the ledger accounts where it is clear. We have opening of 27,000. We have production. Then we have closing. Then the cost of goods sold will be 177,600. So we say opening plus production, which is manufacturing cost, minus closing of 25,000. So we have 27,000 as our opening. Our production being 175,600. Inventory that was finished in the current year, 175,600. This is what was finished in the current year, production cost during the year. Then now we 175,600 and closing inventory being 25,000. And the closing inventory of 25,000 is exactly as it appears in the ledger account. There is the closing inventory given to us 25,000. So opening plus production. Remember, production comes from the credit side of the work in process, which was opening work in process plus material plus labor plus overheads minus closing. That gave us the cost of the finished goods. So now if we do that, our cost of sales will amount to the same 177,600. 27,000 plus 175,600 minus 25,000. It is still the same 177,600. The same amount that we calculated. This is just more of a test. Then we need to know how much is our sales from the information that is provided to us. Our sales are given to us as sales 400,000 rands. So we just copy and paste our sales as 400,000 rands. Then sales minus cost of sales will give us gross profit. And our gross profit will be minus 400,000. And subtracting that 400,000, we get 222,400 rands. Just confirm that 400,000 minus 177,600. It is 222,400 400 rands. This is our gross profit. Then after we say less other expenses, remember our other expenses will still be telephone. Our telephone, they said that out of that 5,000 of telephone, 40% was non-manufacturing cost. So now, and that 40% amounted to 2,000 rands. If you remember, with regards to telephone, all the other costs were not related to manufacturing. So now they said 60% of them were manufacturing, therefore 40% were non-manufacturing cost. And all the joint costs. Then 40% of this, water and light, again 40% of water and electricity, water and light of 10,000, water plus light, times this by 40%. This gives us an amount of 4,000 rands. Then we have our, this is direct cost. It has nothing to do with what we are doing directly, but nothing to do what we are doing. Indirect was already accounted for. Freight on direct material accounted for. Freight on sales 1,000. Freight on sales 1,000. This is the selling cost. It has nothing to do with manufacturing. Freight on sales. This is an amount of 1,000 rand. Then we look for another expense, which is 40% of depreciation of 19,000. Then we have our depreciation. And out of the 19,000 of depreciation, 40% of that is other cost that does not relate to production. Then 19,000 times this by 0.4, it is 7,600. Then we look for another expense that is not manufacturing. This one is manufacturing related. Rent is 40% of rent. Therefore, now we account for rent, and 40% of that 40,000 is non-manufacturing. Then after accounting for that 40,000, times this by 0.4, it gives me 16,000 rands. So now these are the costs that are not related to manufacturing, meaning they are other costs. So now I have to add all of them, 16,000 plus 7,600 plus 1,000 plus 4,000 plus 2,000, and this gives me a total of 30,600 rands, minus the gross profit of 222,400, and this is an amount of 191,800. This is a profit. I don't want to say net profit because net profit is after tax has been accounted for. Net profit for the year. Now we check if was this a period of a year or a period of a month. This was the 1st of January and this is 31st of January. So this is the full accounting period. So this will be net profit for the year, of which the period in this case, it is the period of a year. Now this is how you will be normally compiling your manufacturing statement. This is income statement. From here, this was a manufacturing statement. And I prefer to say this is cost of sales because all that we're calculating was just the cost of sales. This is cost of sales. Because at the end of the day, we ended up getting to the cost of goods sold. Cost of goods sold was 177,600. And we said here, less cost of sales, so this is 177,600. So you might be required to calculate the cost of sales. Or the requirement might say calculate the cost of sales. But here they did not specifically say it must be cost of sales. They just said compile a manufacturing statement, which is calculating cost of sales. Hence now, if you see in my line item, I said specifically that cost of goods sold, which is our cost of sales, and is aligned also with the income statement. And we have done the second requirement, which is income statement, and the third requirement, which is number C, is to calculate the cost per unit. And the cost per unit was under the assumption that if we manufacture 1,000 products, therefore what will be the cost of 1 unit? Then the question is, how many units were manufactured, not how many units were sold. How many units were manufactured in the current period? And the manufacturing cost, or the value or the cost of goods finished. This was the value of goods that were finished. Value of cost of finished goods. This is the value of goods that were finished during the year. Then you said out of what was finished during the year, we added opening. This is production cost, in other words, the cost of goods finished during the year. So now out of that 175,600, we divide that by the total units that were manufactured. So we say 175,600, divide this by 1,000 units, and this will give us 175 rand 60 cents. Let me just confirm that. 175,600, divide this by 1,000, it gets us 175 rand 60 cents. This will be the manufacturing cost per unit. If we manufacture 1 unit, meaning to manufacture 1 unit, it costed us 176 rand 60 cents. Now, with that being said, guys, I hope this makes sense. And once again, remember, the ledger accounts are not required, but it is very important for you to understand the flow from the ledger account perspective. And the minute you understand it from a ledger account perspective, then it becomes easy now for you to apply it in the statement perspective. Now, in closure, with regard to cost of sales, remember here we'll have to record inventory. Sorry to come a little bit backwards. And the inventory that was the cost of what was sold was 177,600. So now that will also have to be applied with regard to the ledger account of cost of sales to record that this inventory worth 177,600 must have been sold. So now this will be where I end, guys. Hope this has added value to your knowledge, and let me say thank you. God bless you. Bye bye.